TCS stands for tax collected at source. It's a method of collecting income tax in India where the tax is collected by a seller from a buyer at the time of sale of specific goods. It's a proactive measure to ensure that tax is collected at the source of the transaction itself, which helps in broadening the tax base and preventing tax evasion. How TCS works. The TCS mechanism involves two parties. The seller, collector, an entity that is required to collect tax under the provisions of the Income Tax Act. The buyer, collectee, the person or entity buying the goods on which TCS is applicable. When a seller sells certain specified goods to a buyer, they are required to collect a small, predetermined percentage of the sale value as tax, in addition to the sale price. The seller then deposits this collected tax with the government and issues a certificate, Form 27D, to the buyer. What is TCS applicable on? TCS is applicable on the sale of a limited list of goods and certain transactions, including alcoholic liquor for human consumption, tendu leaves, timber obtained under a forest lease, scrap, minerals, coal, lignite, and iron ore, motor vehicles exceeding a certain value, currently 10 lakh rupees, overseas tour packages. Sale of any goods, if the seller's turnover exceeds 10 crore rupees in the preceding year and the sale to a single buyer exceeds 50 lakh rupees in the current year. TCS versus TDS. While both are mechanisms for collecting tax at the source, they have a key difference. TDS, tax deducted at source, is deducted by a payer from the income of the payee, e.g., an employer deducting tax from a salary. TCS, tax collected at source, is collected by a seller from the buyer at the time of sale of goods.